Your favorite photogenic influencer would have probably already described to you in graphic detail why markets globally had a meltdown earlier in August. So those of you who have lately been seeing your portfolio going,
What the hell? No.
now know that the disaster was caused by one destructive Molotov cocktail of the Bank of Japan raising its interest rate for the first time in decades, worrying data on US employment, sudden loss of confidence in US tech companies, and Israel and Iran once again getting on each other's nerves and on each other's throats, all happening within a week or so. But as an investor, the key question that you should be asking is, was this a one-off event, or has the music truly stopped? Is the party really over? And a key piece of this jigsaw puzzle is to figure out, is the US really headed for a recession? Should you believe people who tell you that the world is coming to an end, the end is nigh? Or should you put your trust in those who tell you that all of this is just fear-mongering and everything is going to turn out okay? Hello and welcome to the Bond Economist, your one-stop destination for professional advice on the economy. My name is Oradeep Nandi, and today we try to understand what's going on and what's going wrong with the US economy. What is its current state? Where is it headed? What are the risks? What will their central bank do next? And how will all of this impact the Indian economy? As always, if you like this kind of content, please hit like and subscribe. And if you'd like to support me, the super thanks button is below. First things first, let's get you up to speed on the US economy. Allow me to relive for you the trauma of the pandemic. As lockdowns were spreading across the world and people were getting infected and dying, governments and central banks were forced to firefight the economic fallout. Governments across the world started spending like there is literally no tomorrow. And central banks started cutting interest rates to historically low levels. The broad logic is that the economy is weak, no one is spending, people are losing their businesses and their jobs. So let us hotwire the economy by getting the government to spend and in the process putting cash in the hands of people. And for the central bank to bring down borrowing costs and so help those who are paying off loans and encourage people to take on more loans. And so slowly the economy kind of starts recovering. In the case of the US, its central bank, the Federal Reserve or the Fed, cut interest rates from around 2.5% to nearly 0% to rescue growth. So far, so good. Now, generally recessions see a fall in demand for goods and services. So inflation also generally falls. And this gives the central bank the comfort in cutting interest rates, as the central bank, after all, is in charge of inflation. The problem for the Fed was, though, that the pandemic was no ordinary recession, because as lockdown started getting relaxed, inflation started rising. After all, a lot of people had received a lot of money from the government. The government, after all, had spent a gigantic amount of money during and after the pandemic, over 10% of its GDP. So the US is the world's largest economy. 10% of it means hundreds of billions of dollars spent on pandemic support, on handouts, unemployment benefits, loan support, whatnot. The government also funneled close to $40 billion into the domestic semiconductor industry under the CHIPS and Science Act. So it's no surprise that Americans were left with unnatural amount of money in their hands. Economists estimated that at one point, US households were sitting on excess savings to the tune of over $2 trillion. So obviously, they wanted to spend that money. And after the initial few months of uncertainty, much of the white-collar workforce realized that, well, they still had their jobs. Firms and businesses were in fact at one point facing labor shortages and were actually willing to pay more for workers. So wages were also picking up. So good news on growth. So on the one side, demand in the economy was high. On the other hand, the supply side was struggling. The pandemic had disrupted supply chains. It was getting costly to transport things from one part of the world to another. And if things weren't already bad, Russia and Ukraine descended into a full-fledged war, further disrupting supply and increasing geopolitical risks. So demand remained high while supply was low. It's a perfect recipe for higher inflation. Now, this became a problem for the Fed, whose primary job was to control inflation. On the one hand, the economy was just coming out of the pandemic, so you don't want to disturb the economic recovery. On the other hand, inflation was trending at its highest level in decades. So, should the Fed wait for the pandemic related pressures to ebb and for inflation to come down naturally? Or should it just say, forget rescuing the economy, we need to raise interest rates to control inflation? Now, for a long time, the Fed did option one, do nothing. Wait for inflation to naturally come down on its own. By April 2022, though, it realized that it was making a terrible mistake. Inflation didn't look like it was headed down anytime soon. And what was earlier only a concern was now slowly turning into a crisis. Meanwhile, growth was still going strong. And so the Fed changed course. It said, nothing doing, I am hiking interest rates. And boy, did they hike. The Fed fund rate zoomed from 0% to around 5.3% over the course of 1 year. 5.3% increase in interest rates is not a joke. It's like wheeling the economy into an operating theater. And so the Fed told itself that, look, I have tightened financial conditions. Surely now the economy will slow and inflation will come down. Unfortunately, here too, the Fed was proven wrong. The rip-roaring government spending and strong US consumer meant that the usual pain that a sharp increase in interest rates should have caused in the economy just wasn't happening. Also, when interest rates were close to 0%, a lot of homeowners had locked in their mortgages for long periods of time at record low interest rates. So, when interest rates went up in the market, these guys just stuck to the houses they had, knowing that if they were to sell and buy something new, they would have to pay multiple times higher interest rates. So again, housing, a major sector that usually is quite sensitive to interest rates, didn't face the tightening that Fed had intended. And so as the economy shrugged off the Fed hiking interest rates, inflation too remained elevated and remained sticky. Of late, the US economy has started slowing and inflation has been moderating. See, that excess savings that households were sitting on after the pandemic, well, it's mostly spent now. People are now defaulting more and more on their consumer loans, especially those on credit cards. The financial stress from increased interest rates is visible from the sharp rise in loan delinquencies. Surveys of consumer and business optimism have also started coming off. The commercial real estate sector in the US has been facing problems. And very importantly, the labor market is starting to crack. Yes, businesses have not been firing people as much, but they have slowed down hiring. Consequently, lesser and lesser people are now quitting their jobs. And while the number of people filing unemployment claims hasn't surged yet, it is still gradually picking up. Now, one of the reasons why the labor market may not be throwing up really ugly numbers, so far at least, could be because of elevated levels of immigration in the US. But what got markets really alarmed in August was the data of unemployment rate as of July. From a low of around 3.5% in mid-2023, it has now climbed to 4.3% as of July. In fact, the unemployment rate is rising so fast that it has triggered something known as the Sahm rule. Now, some years back, an economist, Claudia Sahm, who used to work with the Federal Reserve at one point of time, observed that in the US, recession periods typically start when the 3-month average unemployment rate has risen by 0.5% or more above the lowest it has been in the past 1 year. So basically, if unemployment rate has risen by a suitably large amount within a year, then it indicates that the economy could be entering into a recession. Because once unemployment starts rising, it's usually not a temporary thing. It triggers a vicious cycle of people losing their jobs, their incomes, cutting down on spending, and in turn impacting profits of firms and businesses who are now required to fire even more people, causing the unemployment rate to pick up further. And you can see this for yourself. The line that you see is the Sahm rule recession indicator. Basically, the difference between the 3-month average unemployment rate and the lowest it has been in the past 12 months. And you can see that whenever the indicator has gone above 0.5%, there has been a recession, which are those gray blocks that you see on the chart. And the problem is that when unemployment rate hit 4.3% as of July, this Sahm rule got triggered, which is why markets are freaking out. Is unemployment rate rising fast enough to suggest that the party is over? Because when things start going south, there's really no saying how much the economy could end up nosediving. Now, a lot of people will tell you that yes, unemployment rate is rising, yes, the Sahm rule is triggered, but calm down. Other economic indicators in the US are still doing fine. GDP growth, retail sales, services sector data all suggest that the economy is still broadly stable and strong. Also, the Sahm rule is not a writing on the wall. It's not like a recession blood test. It's something that has been observed to happen at the start of past recessions, but that alone is no guarantee that a recession will definitely happen. In short, it can indicate a false positive too. But that said, here's the mind-bending thing. Recessions are incredibly difficult to spot, especially when you are in one. Because by the time you get enough data on the economy to get the trends to confirm the recession, the economy in real time would have probably already been in slowdown for months. Take, for instance, the global financial crisis in 2008. We now know that the actual slowdown started happening from end 2007. But back then, people didn't know that they were sitting on a ticking time bomb. In fact, the International Monetary Fund, the IMF, a place chock-block full of some of the brightest economists around the world, even in April 2008, when actually a full-blown slowdown was already happening in the US, the housing market was already starting to collapse, banks were already feeling the heat. Even at that point, the IMF didn't forecast recession. They forecasted GDP growth in the US will be 0.5% in 2008, and guess what? Will recover to 0.6% in 2009. But what happened actually? In 2008, as opposed to their forecast of 0.5%, US's growth was only 0.1%. And instead of 0.6% growth in 2009, the US economy sunk to minus 2.6%. So, we are great at identifying recessions in hindsight, but we are kind of bad in forecasting recessions. Actually, forget forecasting, even realizing that we are in the start of one. So, the market worry is twofold. One, is there a recession round the corner? And two, is the Fed too obsessed about bringing down inflation? So, let's talk inflation. You can see that it has drastically fallen from around 5.5% in mid-2022 to close to 2.5% currently. The Fed's target is 2%. So the shaded parts again indicate the years where the US has faced recessions. The dot-com burst in 2001, the global financial crisis in 2008, 2009, the pandemic in 2020. And you can see that inflation actually comes down during slowdowns and recessions. Also, it is interesting to note that the real bottoming of inflation has happened after the recession has hit. And this is what markets are really worried about now. So if inflation is at 2.5% or so, and the Fed's target is 2%, if the Fed decides to play too safe and keep interest rates high until inflation actually reaches 2%, then it will most likely condemn the economy to a hard landing or a recession. The Fed's problem, on the other hand, has always been, is inflation truly under control? It tried relaxing its communication in end of 2023. Fed officials were saying that sure, inflation is moderating, we should start easing soon. And guess what? In the first quarter of 2024, inflation again started rising. And the Fed had to dial back its rhetoric and again go on the offensive of promising to keep interest rates elevated for longer. Now, inflation is coming off. But again, the latest numbers suggest that core CPI inflation, consumer price index inflation, warmed up in July with rents picking up. And this is what economists call the last mile inflation risks, which means that it is easier to get inflation from say 6% to 3% than it is to get it from 3 to 2.5% and from 2.5% to 2%. Actually, come to think of it, same with weight management. It's easier to say, cut sugar, cut junk food, and rapidly reduce weight from, say, 120 kilos to 90 kilos. But it takes a lot more to get 90 to 80 and 80 to 70 kilos. So here is what the Fed really hopes will happen. This is the best case scenario. Inflation comes down, and in the process of doing that, the US has a soft landing. That is, growth slows moderately and all is well with the world. What it does not want is that inflation remains sticky and refuses to come down to comfortable levels, and meanwhile growth starts worsening, so it becomes difficult for the Fed to continue fighting inflation by keeping interest rates high. And what it really doesn't want is to find out that it had applied brakes so hard that, well, the economic bus has catapulted and tumbled off the recession cliff. So what will the Fed do next? Well, that's the $1 trillion worth question for financial markets. And here's how crazy and paranoid markets have been. The Fed's next scheduled meeting is in September, when they decide on what to do with interest rates. And usually the conventional cut or hike in interest rates at one go is 0.25%. So some in the markets were already expecting that the Fed will start to finally ease rates from September, delivering the first 0.25% cut. But then the unemployment data came in early August and people freaked out. They started pricing in not 0.25% cut, but a double punch of 0.5% cut in interest rates at one go in September. And then rapidly people started wondering, forget September, maybe the Fed will announce an emergency meeting and cut interest rates ASAP. Then the following week, the jobless claims data improved and one of the surveys for the services sector did well. And suddenly markets went chill. Maybe that expectation of emergency rate cut was an overkill. And then the week after, inflation inched higher, and now markets are like, actually forget 0.5%. If they cut, it'll probably be by 0.25%. So in 2 weeks' time, we've had people in the market pricing in 0.5% cut, emergency cut, to now a scheduled cut by only 0.25%. And this is what will probably be visible in the coming weeks and probably even months. Markets just reacting in panic to every incremental piece of data, wondering if this will trigger a turn in the cycle or not. So how will all of this impact India? Well, if the Fed does cut in September, then that's a pretty big deal. It means that effectively the days of higher interest rates globally are over. Now, India has a mini Fed dilemma of its own. The RBI has kept interest rates elevated at 6.5% because it feels that inflation is still not durably at its 4% target, and because it sees growth strong. In FY25, it's forecasting 7.2%. So basically, it feels that there isn't much harm in keeping interest rates high. However, core inflation in India, so again, ex food and fuel, has come down drastically, and growth indicators have started to show signs of fatigue. So people are now wondering when the RBI will similarly change course and start cutting rates. Now, all other things being equal, if the Fed starts cutting and other central banks in fact are also joining in, then the RBI will have more flexibility to do the same for India. But if a recession happens in the US, then the shock waves will inevitably extend to India's shores. After all, US is probably the most important customer of India's goods and services exports and is a major investor into our markets and companies. And when global investors panic, they usually dump risky emerging market assets like Indian securities and rush back to the safety of the dollar. And hence, it could very well be the case that our currency could sharply weaken if that happens. That said, the Indian economy has been remarkably resilient to global shocks lately. We have strong macro fundamentals, stable growth, low inflation, low current account deficit, under control fiscal deficit, more than enough forex reserves. So even if a US shock happens, we should be able to bounce back relatively easily. For more such insights, like, share and subscribe to the Bond Economist.